I think there's no question about it, and I don't think anyone debates this, but our markets are currently in a bubble. Who thought? If you sneeze sideways and an algorithm picks up on AI during mid-sneeze, your stock is prone to go up 10 to 20% following earnings. The real question is AI truly a 2000s-like bubble, or is this bubble somewhat justified? I think, long story short, it's kind of justified, at least if you look at Nvidia and select other stocks. They have already started to benefit fundamentally from AI. But I do think we may have went a little too far, a little too fast. We have some shocking new statistics to share with you about our markets and how things might be taking a turn for the worst as you are actually watching this video. This is not a healthy market. This is a very sick market. And if you are a Tesla stock investor, I'm sure you already know this. It's not too often that Tesla stock falls about 30% in a month. Beyond that, the Fed said something that I think you need to know, specifically Fed Kashkari today, and we have more Fed speakers coming tomorrow. I will give you the lineup and what times they will be speaking. I will also share with you what I think is coming next for our markets and how 2024 may start to play out. Along those same lines, where I think Tesla stock is going next and when Tesla could finally bottom. Last but not least, we'll actually start this video off with Cathie Wood. She had a lot to say about the Delaware Chancery Court. Cathie Wood is throwing bombs out there. She says, "I believe the Delaware court's decision forcing Tesla to void the March 2018 vote on Elon Musk's performance-based pay package is un-American, an assault on investor rights, and an insult to the board of directors of one of the most stunningly successful companies in U.S. history." She said, in its ruling against Elon Musk's pay for performance compensation package, Delaware seems to question whether it was fair to all shareholders, given the results 5 years later, with Tesla up 13-fold from the time of the vote to its peak in November of 2021, and still up 9-fold today. I would like to understand what Delaware means by, quote, fairness. Cathie says, working with ARK Invest general counsel, who looked at the 200-plus page Delaware court's decision, I have concluded that legal nuances and the controversial interpretation of them have missed the forest for the trees, spectacularly and unfairly. Tesla's board incentivized Elon Musk with a Herculean task that most analysts and auto manufacturers did not believe possible. Based on our research centered on Wright's Law, we believed that Tesla could meet the performance goals, but only with brilliant execution. In fact, we were thrilled to learn in February of 2018 that Elon Musk and the board were aiming so high, reaching for our bull case price target in 2023 of $4,000 or $265 per share on a split adjusted basis, a 13-fold increase from roughly $21 when I announced our price target on CNBC. On behalf of our clients, ARK Invest voted for Elon Musk's compensation, as did 80% of shareholders. Nearly 5 years later, a Delaware judge has overruled the board and shareholders, the latter whom had the benefit of ample debate about the incentive plan's probability. Agreeing to no salary during those 5 years, Elon also would have received much less performance-related compensation if he had achieved less than the lofty milestones associated with our bull case. Instead, he shocked and delighted shareholders. Thanks to Elon's ingenuity and dogged determination, Tesla hit our bull case target in 2021, 2 years earlier than we anticipated. Since then, many shareholders have shared stories with us about how our research inspired their investment in Tesla and changed their life. They bought their first homes, put their children through college, and added to their retirement nest eggs, thanks to Tesla. Tesla's story emphasizes why people have flocked to America. The Delaware court's decision is an embarrassment to our country's ideals and a travesty. Cathie Wood also takes it a step further and confirms that the Delaware plaintiff lawyers came after them, but brilliant attorney Jane Cantor had prepared us. so the big dogs walked away. I have asked my legal team to extract us from Delaware. Once was a beacon for entrepreneurs and investors in the US, but now a menace. I mean, it seems like for one reason or another, Elon is constantly being attacked, to the point government officials are speaking out, like Brandon Carr, who is the chairman of the FTCC. After all, Biden won't even mention Tesla at EV rallies, but has no problem mentioning GM when Tesla sold 10 times more EVs than GM did last year. Not to point fingers at any one person, one county, one country, one state for that matter, the narrative is the same. Tesla is being attacked in every way, shape, or form possible, both politically, personally, in the case of Elon apparently doing drugs. That's the big story that came out today. Partially the reason why Tesla stock fell, among many other reasons. It seems like there's always many reasons now Tesla stock is falling. Now down 30%. May I mention, since the start of 2024, when nothing has changed with the company fundamentally, is this a buying opportunity or is this not? I think the answer for long-term investors is a simple one. Tesla could end up reaching $5, $10, $20 trillion or more in market cap in due time. I'm not a financial advisor. That's not financial advice. But normally you make the money when you buy a stock, not when you sell a stock. If you buy a great company, you'll do well. If you buy a poor company, well, you won't. It's pretty simple. It doesn't matter if you buy a poor company and sell a poor company. You don't make money on the sell, you make money on the buy, and the lower Tesla stock goes, the better the buying is. Now, a lot of people are starting to speculate that Tesla could fall to about 150 before finding a more definitive bottom. Now, I will say today, Tesla broke under 180. Now, I expect Tesla will hold support at 180 unless the markets actually start to fall themselves. And unfortunately, we are starting to see deeper cracks out there in our markets that you cannot ignore anymore. Thus, Tesla stock may inevitably fall down to about 150. Based on my assumptions, the S&P 500 should be about 5% lower today than it currently is. That is my assessment from looking at this chart. This is the percent of stocks above their 50-day moving average, showing a massive, massive disparity here. Because after all, you hit the lows at about 15%. 15% of stocks above 50-day moving averages, that's really bad. You're in a full-on capitulation moment when you're that low, okay? But you're really sitting at about 20 for the average during this period from October until the beginning of November. You bottom during that period of time. The S&P 500 has rallied nonstop, literally nonstop. But what happened with this chart? Again, the percentage of stocks above their 50-day moving average. It hit a high on December 28th, which is coincidentally the same day Tesla stock hit its high. What's been happening ever since? You've fallen from 86% to 46%. What's happened to the S&P 500 during this same period of time? From late December until now, it's continued to hit new all-time highs. This market, my friends, is sick, very unhealthy. Under the surface, stocks have repriced. They have essentially crashed since the start of 2024, Tesla included. Look at a Fubo, look at many other stocks. They've not done well. But here's something I think is a little bit more troubling than even that chart, because this is a chart of the dollar. Now, when the dollar rises, stocks tend to fall. When the dollar falls, stocks tend to rise. Look at this thing on a weekly chart. No shocker why 2021 was a great year and everything seemed to do well. The dollar fell precipitously from the Rona, which was right here. The dollar instantly started to fall, like within a couple of weeks, and you had massive stimulus. Among other reasons, stocks did well. No wonder stocks did poorly in 2022. Look at the dollar. It was pretty much vertical. It's like a roller coaster you'd want to ride, right? It was pretty much straight up. What happened in 2023? The dollar fell. Stocks performed well. But you really got to look at the nuances here. You got to look at shorter term intervals, because what happened from really the banking crisis until July? Stocks did very well. AI was the new craze. At least it started the first time around. What happened during this period of time? Really from May until July? The dollar fell. with a slight little move higher here, and stocks took a little move lower, but really it just plummeted. And then you hit the lows and the dollar started to rise. What happened? This caused a 10.5% correction in the markets. What happened following October, right? Which was right about here, the end of October. Literally right freaking here. You cannot make this up, okay? It literally coincides exactly when you get the start of weakness or the end of weakness in markets. So right here, the dollar starts to fall. This is the end of October. Stocks start to do well and go on a multi-month rally until when? When, you guessed it, December 28th. The dollar has been rising basically ever since then in a pretty vertical straight line as well. What's happened? The S&P 500 has also been rising. This does not normally happen. It doesn't. That's a fact. You cannot argue that. And the reason why the dollar has this correlation to the markets is because if you're a multinational corporation like Nvidia, like Apple, like Google, like Microsoft, like Tesla, all of your big tech names, most of your markets that do business in foreign currencies, if you take in a foreign currency that's strong and convert that to a weak dollar, you're going to get more dollars. When the dollar's low, that's why, businesses do well and stocks do well. When the dollar is high and you're taking in weak foreign currencies, converting weak foreign currencies to dollars, you're getting less dollars. It fundamentally affects your earnings. Not to mention the much hotter than expected ISM services prices for the month of January coming in at 64. Expectation was 56.5. I mean, you add this together, it looks like inflation is going to be a lot stickier than what people thought. At a time where the Fed said in January they only plan to cut, or December, they only plan to cut rates about 3 times in 2024, markets priced in 7 rate cuts. Then you drop to 6. Now you've dropped to 5. And you see what the average stock has done. It hasn't hit the index though, but it has hit the average stock going from 7 rate cuts to 5. Imagine what happens if we go from 5 to 4 to 3 to 2 to 1, maybe to 0 rate cuts in 2024. Good news is your average stock is more prepared for this. Maybe your larger cap names are not, but I think that brings up another question. Does that cause big downside in our markets? And I think to some extent it would have to, but obviously big tech names are a little less dependent on interest rates, but it would still have a large effect on markets. I think it's also worth mentioning that basically anyone that was remotely bearish on markets has totally flip-flopped. Mike Wilson, one of the biggest bears of 2022 and 2023, like literally going on CNBC every day saying S&P 500 is going to fall to 3,200, which is 320 on the SPY. Let's just put that into a little bit of context for everyone. That would be the S&P down to about here. Mike Wilson was saying up until the last couple of months that the S&P could still fall around 35%. What did Mike Wilson do? He came out 2 days ago and said stocks are just going to broaden out from here. The rally is going to continue. All is fine. Today, Goldman Sachs upgraded Nvidia stock and says it can hit $800 per share after rallying about 400% over the past year or so. They raised their price target $175 from $625 to $800 per share today and continued to hold Nvidia stock on their conviction list for 2024. At the same time, you have China placing new trading restrictions on domestic and foreign investors as the CSI 1000 index hits a 30% loss year to date. New restrictions include 4 things. Number 1, limiting investors' ability to short Hong Kong stocks. 2, some investors told they are not allowed to sell their positions. 3, some quant funds are completely banned from placing sell orders. And number 4, other quant funds banned from cutting leveraged positions. So in a month, small cap Chinese stocks have dropped 30%. And this is the world's second largest economy. And we're just going to continue to hit new all-time highs. I don't have to be a statistical expert to know that's statistically improbable. And then just today, 30% of all stocks in China have been halted as China CSI 1000 index slides 8% in just a matter of hours. Just another day, another 8% loss. Another 3% loss on the Shanghai Composite, Shenzhen down 4%, Beijing 50 down 4%, and the Star 50 down 5%. Just another day in China, I guess. Now, to kind of round this off, this case that I'm presenting to you guys, let me know again down below in the comment section what you think about this information. If you think I'm delusional, if you think stocks are just going to continue higher or not. The fourth year of a new president tends to see most of the gains later in the year. So you average about 12.2% the fourth year of a new president, which is this year. Now you tend to have a weak first half of the year and a very strong end of the year. I'll tell you right now, in markets, the most likely thing typically does not happen. The most likely thing in late 2022 was a recession in 2023. That did not happen. At one point, 100% of people, according to Bloomberg, were expecting a recession in 2023. Everyone thought Nvidia's demand was drying up. The gaming sector was not really doing anything. And what happened? AI emerged as a result. The stock went from $100 to $700. And those of you guys that took the opposite end of consensus made a lot of money. So there's a good chance, as inflation remains stubbornly high, as rate cuts get maybe fully priced out of the markets by mid-year, by third quarter of 2024, the second half of the year could actually be a rough one for the indexes. Now, I think a lot of the pain is already getting priced in for the bottom half of the markets. Again, the 60% of stocks or so that are trading under their 50-day moving average today. I think a lot of the damage is already done for a stock like Tesla. You have seen a multi-year loss equivalent in just the first month. You're down almost 30%. At one point, you were down over 30% in Tesla stock when the stock was down like 7% today. You're down a little bit less than that for 2024 right now, but point is still the same. You've seen the loss already. Now, I think the next big event that will be very important for markets is Nvidia earnings. Nvidia tends to buy the rumor, sell the news when it comes to Nvidia earnings. Now, Nvidia over the past 2 quarters has not collapsed following earnings, really 3 quarters now. Nvidia doesn't like collapse. They don't see big down days following earnings because they pretty much always beat expectations, right? And by a very large margin, they raise guidance a lot more than expected. But Nvidia does tend to have a week or 2 cooling off period following their earnings. And that is when potentially we could see more downside for the broader markets. And let's be honest, when CoinPriceForecast.com expects the S&P 500 ETF, the SPY, will reach $600 by the end of 2025, and Yardeni Research believes the S&P 500 will jump nearly 30% to 6,000 by 2025. It's probably a healthy thing to have a correction in the markets, not just on a price basis, but on a mental basis. If you're expecting 30% in 2 years, I mean, if you're expecting that, that's a wild expectation. Again, remember, against the backdrop of the dollar rising and the markets really being sick here, and China's markets just going through another normal day, normal month, down 30% in a month, to have these kind of expectations, it leads me to believe stocks can be a little bit toppy here, and you should be careful if you are balls to the walls in long positions. Fed Kashkari today also dropped a bit of a bombshell. He says the current stance of monetary policy may not be as tight as we would have assumed, given the low neutral rate environment that existed before the pandemic. It is possible that the policy stance that represents neutral has increased. Fancy way of saying, yeah, we may not even be that restrictive on the economy, thus we probably won't cut rates until we need to. Jerome Powell and the Fed have made it very clear. They would rather be a little too high for a little too long because they can always cut rates than to cut rates prematurely, let inflation rise again, and then have to pull Volcker or the economy. Now, coming tomorrow, it's going to be a bit of a slower day. You are going to get highlighted in red here. IVPMI for January coming out of Canada. I'm not sure why that is expected to be a big volatility event. It's not going to move our markets at all. But at 11 o'clock in the morning, you are going to get total household debt. A lot of markets will pay attention to that. Last month, you were at 17.29 trillion. I imagine you're going to be probably 17.5 trillion following the shopping quarter. Fed Mester will speak at noon, Fed Kashkari at 1 p.m., and Fed Collins at 2 p.m. So the big story is really going to be about the Fed, and we're starting to hear more talk from Fed officials, and it's not sounding great. And if the Fed really wants to push back on the 5 rate cuts markets are pricing in, considering the data that just came out today on hotter than expected inflation in the service sector, their chance to do that is probably tomorrow. And Fed Mester, Fed Kashkari, and Fed Collins tend to be a little bit more on the hawkish side, so tomorrow could be another slightly red day for the index. But after all, what's another slightly red day when Tesla stock's down 30% in a month? And to nobody's surprise, you had about 1,200 orders from hedge fund and institutional investors in Tesla stock today, worth $656 million, with a positive order value of 44%, so a little bit more bearish than bullish. As far as earnings, you are going to get Eli Lilly pre-market tomorrow, Spotify, Fiserv, Hertz, BP, Toyota, and some other names. Tomorrow and after hours is the big story. You have Snapchat, Enphase, Ford, Chipotle, Fortinet, Amgen, and some other names. Throughout the rest of this week, Uber, CVS Health, Roblox, XPO Logistics, Alibaba, Wednesday pre-market, PayPal, Walt Disney, ARM, Wynn, Pay.com, Mattel, Wednesday and after hours. Thursday pre-market, not too many names there. You do have Hershey's and Spirit, ConocoPhillips, and Philip Morris. Thursday and after hours, Affirm, Pinterest, Cloudflare, Dexcom, Expedia, Bill.com, Take-Two Interactive. Friday pre-market, Pepsi, Canopy Growth, AMC Networks, and some names I'm sure nobody cares about. Let me know what you think about all of this information down below in the comment section. Are you bullish? Are you bearish? Are people too far over their skis in the biggest names in our markets? And are those names going to give up and cause stocks to fall? After all, there's no arguing that things don't look good right now. But again, let me know your opinions down below in the comment section. Hit the like button as well as subscribe to the channel. If you guys want to come trade with us, check out that link down below in the description of this video as well. You guys have a great rest of your day, and I will see you in the next one.